Time for a three-stock dinner. We're tracking three of the day's movers and digging deeper into how to play them. Joining us to take a closer look at the names is Delano Sapporo, founder at New Street Advisors Group and a CNBC contributor. Delano, great to have you here. Let's start off with Meta. Shares of that stock well off the highs of the day after earlier climbing on reports that more layoffs are on the way at the company, along with a fresh round of legislation against TikTok, perhaps, which could help drive Meta's Reels business. So, Delano, this is a rare stock that's doubled off the lows, but is still at half of its peak historic value of about a year and a half ago. So what's your take?
Yeah, you're right. It's been an analyst favorite since the start of the year, and those people that were lucky enough to buy it at the trough have done pretty well. But, I think a lot of people are wondering if it was structural issues, if it was macro issues. I think it was actually a little bit of both when you saw the stock take a hit. And now there's the recovery story, the turnaround. I think they fixed some of the structural issues. The consumer and ad spend might be in a little bit better position than we initially thought if you look back 6 months ago. And they've done a lot to focus on profits, which with growth slowing, investors wanted to take a look at the bottom line, and they've done a lot to focus on the cost structure. So I think this is a hold and something that I've been holding. And I think if you're looking at it, also with the buyback, that's going to do something that's going to help stock sentiment for the foreseeable future. So I think this is one that you'd want to keep holding. Is the potential TikTok ban a big reason to hold it, or do you feel like that would be a bonus, or would they be a beneficiary in that scenario? I think, that's heavy competition for Meta. But for Meta, I obviously look at, having 2 billion people, individuals on their family of apps. From my standpoint, I want to continue to see growth and profitability. Competition is always going to pop up, and I think they've usually done a good job either trying to acquire or copy some of the products or do some things to kind of mitigate that risk. But for me, I'm looking more at the company. Yeah. And that competition, they've always done a good job of pivoting from that. I don't think the ban plays a big part here. I think that's something that will, see get worked out. But I think it's more focused on what Meta is doing intrinsically is going to be the big focus. All right. Next up, Goldman Sachs highlighting Amazon as a top e-commerce pick for 2023. So, Delano, what are your thoughts on this one? It's really been a broken stock for a little while. Yeah, it has been a broken stock, and it's been one that I've been holding for a while. And I think if you look at, just from the AWS side, things are maybe a little bit broken, but they're a little bit bent, but they're not broken. It's still a clear leader in cloud computing. And the slowdown, I think, is kind of purely macro driven. If you look at, what's been going on in the environment, and now that we know the consumer may not be in as worse position as we thought, that's an opportunity for us to continue to see retail and e-commerce stay steady throughout 2023, and that might be a big, driver to the upside for Amazon. So this is a company that, they also focus on cost efficiency. So CapEx grew a lot between 2018 and 2022 at a compound annual growth rate of about 48%. So now that all big tech companies are focusing on that cost efficiency, this might be an opportunity for investors to be buying Amazon, a particular area where they've been struggling and wait for that turnaround. Yeah. All right, lastly, CrowdStrike, the software stock jumping after reporting beats on the top and bottom lines and giving strong guidance for the year. So what do you think? Would you buy this one up 6% here? Yeah, so this is one that's going to be a volatile ride for investors. Obviously, a newly IPO'd stock, even though the company's over a decade old. I think, when you look at security, and you look at IT spend, we all thought, IT spend or enterprise spend will come down a little bit. But security is one that's not softening as much as other areas of enterprise spend. So I think that's a positive for the company. Corporations and governments continue to spend. It's still unprofitable on a GAAP basis. So if you're an investor, you're going to have to look at how much you're willing to pay for growth for a company that's still, struggling to get to profitability. If you want to take a chance on the stock, it's something that you want to do with, a little bit of capital that you're willing to proceed with that. But on the positive side, again, they have minimal debt. They have a lot of cash. So structurally, they're set up pretty nicely. So I think this is one you could potentially own. Yeah, and I mean, trading at less than half where it traded a year and a half ago. So, I mean, at some point, people were willing to really put a huge multiple on those sales when they were much lower. 100%. They were when they were much lower, and now there's an opportunity where it's a lot more attractive at this opportunity. And if you're looking past, things right now, this is a company that you want to hold for a little bit because they're in a growth industry, and this industry is continuing to keep growing. And if they're continuing to eat up market share, it could be a potential benefit for investors there. Delano, great to catch up with you. Thanks a lot.